Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's take a look at what has gone on overnight. Global equities struggling for direction in the absence of any significant market-moving news. Wall Street stocks fell with the S&P 500 ending 6 straight sessions of gains as Treasury yields rose. Stocks specifically, Home Depot reversing early gains after the home improvement retailer reported first quarter sales which beat Wall Street estimates, while saying it will keep prices unchanged despite US tariffs that may make some products unavailable. Tesla rose after Chief Executive Elon Musk said that at an economic forum in Qatar that he was still committed to remain as CEO in 5 years. Other tech heavyweight stocks fell, including Nvidia, with the chipmaker scheduled to report quarterly earnings next week. Well, President Trump continues to pressure Republicans in the US Congress to back his tax cut bill, but reports indicate a number of the party faithful are unconvinced the bill would extend the 2017 tax cuts that he implemented and passed in the first term and added tax breaks on income from tips and overtime pay. Economists estimate the legislation, if passed, could add up to $5 trillion to the federal government's $36 trillion debt. FOMC member Alberto Muslim has said tariffs will likely weigh on the US economy, saying if a cycle of high tariffs and retaliation is sustained, economic activity and employment are likely to moderate meaningfully over the next few quarters and inflation is likely to rise. Well, the 2-year Treasury note in the US has fallen around 2 basis points to 3.96%. The 10-year was little changed at 4.47. And the US dollar weakened in part by more cautious remarks about the economy by the Federal Reserve. The Aussie dollar did fall around 0.5% to currently at 64.3 US cents. That, of course, after the Reserve Bank yesterday cut the cash rate by 25 basis points and left the door open for further easing in the months ahead. Bitcoin touching $107,000 overnight, just easing back from that position. On the commodities front, now oil prices just surging in the past hour or two on reports from US intelligence that Israel may be preparing to strike Iranian nuclear facilities. So we'll keep an eye on that development across the day. Elsewhere, copper weakening slightly, along with iron ore, which is trading around $100 a tonne. And gold has gained as the US dollar weakened and risk appetite waned. Spot gold up by 1.7% at $3,289 an ounce. Well, for more on global markets, with a focus on what we're seeing in the US, particularly in light of earnings results, I caught up with Elfreda Jonker from Alphinity Investment Management.
Hard to believe that global equity markets have rallied back so hard that both the S&P and NASDAQ are sort of within 3% of their all-time highs. So it certainly feels a bit like a market that's not pricing in a lot of the risks that's still out there.
Does that worry you? I mean, how are you responding to that?
Yeah, it definitely is a worry. I think if you look at the earnings, which is always our main focus, is that you consistently still see earnings downgrades, even after the first quarter results that were probably better than expected, but those were against very lowered expectations. So you still see across most sectors continuation of earnings downgrades. So if you have a situation where multiples, as we currently have it, well, the US at 22 times, well above the long-term average, you just don't have that sort of safety net there in case you don't get the earnings. And from a macro perspective, there's obviously still a huge amount of risk and question marks around what the ultimate tariffs will be and what the ultimate implications would be for GDP growth.
Yeah, still so much uncertainty, and that's obviously reflected in what we're hearing from those companies too, cautious about guidance or not offering guidance.
Yeah, this first quarter 25 was probably the first time that we saw a variety of reactions by companies. Some are just not giving guidance, others are giving you multiple versions of a bull and a bear case and what they would expect then for full year guidance, and then others would keep it steady but include the caveat of the macroeconomic backdrop and tariffs. I think it's fair to say that it's just hugely uncertain across the board, and it's not just US, it's globally. Speaking to a lot of corporates on our roadshows, it's very clear that the uncertainty is still prevailing regardless of this 90-day truce between the US and China.
Tariffs aside, we're also hearing some policy developments in regards to chips from Donald Trump. He struck some deals in the Middle East. But also healthcare as well, maybe more to come, particularly as far as he obviously wants to lower those prices for American consumers.
Yeah, I think that's probably the one sector that historically has always been a defensive one that you go to through volatile times and uncertain times, but this time around it's probably been one of the worst. And it is because the sector is facing the most, I would say, uphill that they've ever had before, because it's a combination of regulatory risk, tariff risk, and then there's also some scrutiny around the behavior around certain of these companies. So something like the most preferred nation is really a big issue for these companies. And one of our PMs just went to the US last week, and he said he's probably never, to a healthcare conference, he said he's never seen the sector this unsure and unsettled in a way. So for us, it's definitely a sector that we continue to avoid. There's a lot of risk that can still come their way. I think within the sector, you need to be sort of break it down, and they're not all the same. MedTech within that is probably still the safest portion, rather than just the pure pharma companies that will definitely be facing a lot of pricing issues. So in that space, we still have a company like Intuitive Surgical, for example. So all of these companies will be impacted by tariffs, but Intuitive Surgical, as well as Thermo Fisher, for example, that cut in their guidance, they incorporated the worst case already. So even if we come out with something a little bit better than the worst case, these companies could still see some upside.
Now, what are you seeing among the Mag 7 stocks, given they've reported, although we do have NVIDIA to come next week?
Yeah, it's been very interesting because normally they move together as a cohort and they're all very similar with certain weaknesses and strengths. This time around, there was definitely, I would say, a disparity between the names that's already reported. So on the one hand, you had Microsoft, which is still our preferred pick and came through with a really, really strong first quarter result. It's a little bit of a self-heal situation because a few quarters ago, they were definitely not the best. And this time around, they managed to give us, 30+% growth on their cloud business, which was absolutely phenomenal. They're winning on AI, and they're just making a lot of strides across the board, infusing AI across all their products. Amazon was okay, probably a little bit light and some margin pressure coming through, and particularly that AWS cloud business a bit light. But the two that really stood out for us is where we're starting to see some structural issues, and that was Apple and Alphabet or Google. So Apple, firstly, they were always sort of really good at being at the front foot of new products, and this time around, it definitely doesn't feel like they are winning the AI game. So for them, it's definitely an issue as well if they are not going to get that $25 billion from Google anymore, given the scrutiny from the regulators. And then also they still need to just spend a lot and trying to get more product out there and sort of continue to win that new race. So we are definitely more underweight Apple at the moment. And then the big one, Alphabet or Google, we actually sold out of that one. And it's really because we're starting to see that search business that's really their bread and butter come under pressure. And it's not a surprise. We've seen, 5 to 10 new chatbots like ChatGPT coming out. And it's not just for, informational use, it's also for commercial use. And that is a concern for us. So we have sold out of that and prefer to stay with the more steady, more defensive of the bunch being Microsoft.
But overall, you are underweight the Mag 7. So where have you deployed that cash?
Yeah, so we have been consistently reducing the Mag 7 over the last sort of 6 to 12 months, I would say, taking a bit of profit. We still have NVIDIA, but where we have been moving that is more into ServiceNow, for example, which is sort of that third stage of AI beneficiaries. And in particular, they are really the leaders in agentic AI or AI agents, as you call it. So they really are at the forefront and benefiting from a lot of automation of workflow by corporates in general. And then also companies like TSMC, which we still see as very well supported, given the new commitment from Mag 7 on additional capex spend and increasing their capex. And then also names like Tencent, which sits in China, which is really one of the big winning tech companies there, growing at 20-30%. And they're sort of a combination across the board. They're into video games, but they also have social media platform, payment systems, and so forth. So that for us is a stock that we think can still grow a lot and trade at more reasonable valuations.
And Elfreda, just finally, we've heard more recently from the retailers. What are you seeing there? Walmart, with a warning there, those tariffs are going to have an impact. Just overnight, Home Depot saying, look, it's actually going to be keeping those prices unchanged despite the tariff.
Yeah, I think in general, in the first quarter, we're definitely starting to see the impact on the US consumer. We started to see that previously in some of the softer data, like the confidence data coming down, but this time around, we're starting to see it in hard data. So the sort of sales growth that came through from consumer discretionary as well as staples were well below what the market was hoping for. And it really boils down to the tariffs and how they are negotiating it. So we, for example, we had Chipotle, which we also sold out of. But for Walmart, for example, I don't think they've done as an amazing job as Home Depot has done with diversifying their supply chain. I think Home Depot basically said that over the last 10 years, they consistently did it. And by 2030, they don't expect any country to have more than 10% of their supply, offer more than 10% of their supply. So that is where I think this is going to be a year where you need to be very specific about looking at companies rather than sectors, because there will be winners and losers within these sectors. And something like a Walmart, a company like Walmart, fantastic company, and they clearly decided to start to speak up against Trump because their margins are really small. They've got 4-5% margins, whereas some of the other retailers like the Lululemon would sit at 30%, for example. So these companies are willing to take some of the pain, but they want to be clear and honest that it's going to be way more than what they actually expect. So underweight US consumer is certainly the way we're currently positioned.
That is the view of Elfreda Jonker from Alphinity Investment Management. Okay, let's refocus then on what we're seeing locally. We are expecting higher open SPI futures up 0.2%. So we'll take a look at that, see if we begin in the positive in just a couple of minutes' time. Stay with us.